Hello, I'm Finola Burke from RaaS, and we're catching up today with Martin Filz, the Managing Director, and Melinda Sheppard, the Chief Operating Officer of Pureprofile, ASX ticker PPL. Pureprofile is a data and insights and media business operating in both Asia Pac and has a growing presence in the UK, EU, and the US. Welcome, Martin and Mel. Martin, I'm going to start with you first. You've reported record Q1 revenues of 12 million, up 17% on the PCP, driven predominantly by your data and insights business. Can you give us a sense of the demand that you're experiencing within this business?
Yeah, hi Finola, and thank you for having this chat. Good question. I mean, one of the important points also about the record numbers for Q1 is that it's seasonally not our busiest quarter. So not even that it being a record quarter, it actually sits behind Q2 and Q4 as generally our busiest quarters. So that's what we're really pleased with. Why are we seeing that growth in data and insights? Because that's where we put the investment. It's as simple as that, and it's paying off. So we talked, and Mel talked about this in our full year results. In Q4, we put on extra resources, commercial resources out of the UK office, some minor commercial resources, smaller amount in Australian office as well, and they're all paying dividends. They've come on faster than we expected it to come on, and that's our strategy. Our strategy is to take this fantastic Australian business that we have and growing that globally, and that's what we're successfully doing. So it's working, Finola.
And Martin, how resilient is this business in a high inflation environment? Obviously, that's what we're in now. How do you feel the resilience of the business is?
Yeah, there's sort of four sides to that, if I can do. The first element to that is that the growth of our business, the strong growth, is coming outside of Australia, where we have a small market share. And so even if there are inflation troubles, recessionary problems, economic problems, etc., because we have such a small market share, we're still growing, and we still have the opportunity to grow by adding commercial people. So outside of Australia, we're less impacted, if we're not at all impacted. In Australia, we're market leaders, and so we're slightly exposed there. And I was hearing a report just this morning that the Australian economy is doing well. And if you look at the inflationary numbers, we're lower than the rest of the world. We have the same Prime Minister we've had for a little while now compared to other countries. So that gives us confidence in Australian markets. So that's one point. Second point is that actually during macroeconomic challenges that we see at the moment, data and insights grows. And the reason data and insights grows is because organizations want to stay close to their consumers and understand how can they sell more, how can they get out of the troubles or concerns that they have. And then also to say that Mel and I are both really conservative in the business. So, we've seen the amazing growth over the last 2 years, gone from 24 million to 41 million last financial year. But that is with both of us focusing on being cash flow positive, shrinking that net profit loss, which we've done, growing that EBITDA line and that percentage line. And that is what puts us in really good stead for any challenges that come up in the future. And so we're being super cautious about where we invest, how we invest, so that should we need to pull any of that back, then we can do. But to be honest, both Mel and I, that's how we run the books anyway.
Thanks, Martin. Now, Mel, Martin did touch upon this a little bit, but you have made that significant investment in people over the last a year or so. When do you expect to see the payback in terms of profit contribution?
Yeah, well, as Martin said, we're actually really pleased with the progress with a lot of our new team members that joined us over the back end of FY22, and obviously the new ones coming in the first quarter of the year. In fact, actually, one of our newbies that started in Q4 has brought a new client in, actually was top, like number 4 for the quarter. So you can see some new individuals can come on board and bring some quite large clients with them. So we're really pleased about the progress of the team that we've got, our existing team, and also a lot of our newbies. So as we indicated in our Q1 update, our EBITDA progress for Q1 was better than what we'd expected, which we are thrilled about. We are still reiterating that our guidance for EBITDA margin is between 9 and 10%. We're progressing well towards that. And the way that we think about the investment is it will take a little bit for the team to ramp up. And so what you should expect to see over the remainder of the year, obviously at a margin of about 8% in Q1, that you'll start to see that margin climbing up so that you get to an average of 9 to 10% over the whole year. That said, we'd obviously love to see a slightly better result than that. I think that's a really nice way to run the business is, delivering on what we say we're going to. And so that's really important from us from that perspective. But we do know that we'll really start to see that margin from those newbies improving and really adding a lot towards the end of the year across half two predominantly.
And Melinda, you made the decision in Q1 to close the Pure Amplify media business in the UK. Are there any cost savings from doing this, and how does this business look going forward?
Yeah, so effectively, we had 3 team members for that part of the business. It was actually part of the old cohort. It was the UK part of the cohort acquisition that we made back in 2016. So not a huge amount of cost savings. We do believe that we'll retain some of the clients and they will be serviced out of our Australian business from our team there. We've got a medium-sized team for our Pure Amplify media business. So we will take a small amount of cost savings from not having anyone in the UK. We'll retain a little bit of the revenue from that perspective. But the type of revenue in the UK was slightly different to what our team does in Australia. It's more performance type marketing revenue, which we're concerned over, the UK, with the UK economy that would be more impacted this year. It's always made either a small loss or been relatively break even. And we just thought now, with the rest of the business growing really fast, that our time's better spent focused on the parts of the business where, we can really create great value in the organisation. So that's why we made that decision. And I'd been considering it for a little while.
And I'm not sure if it's a question for you or Martin, but the SaaS business looked a little bit weaker in this last quarter. Was that COVID related, and what else is driving that business?
Yeah, it's a good question. No, absolutely not COVID related. We've got Flybys as a major partner in our SaaS business. When you've got anybody as big as that, it can have a slight fluctuation in the SaaS revenues. It was public knowledge they had a slight outage of Flybys, the system back in May of our last financial year, but May 22, and that's just a slight knock-on effect from that, to be honest. So nothing else. We're happy with how the SaaS business is going. We've got some exciting new partnerships that we're at later stage discussions with at the moment. When you have a big partner like Flybys, it can make some effect, and we would expect to see that carry on and grow year over year. Perhaps not 227% growth that we saw last year, but certainly see it grow in full year.
All right. And does this current market, Martin, provide any opportunities for mergers and acquisitions? I mean, could we expect to see something emerge through the course of the next 12 months?
Yeah, it absolutely does. I think it does two things. The first thing it stops happening is doing any major acquisitions. So we certainly feel that every CEO says this, but Pureprofile is undervalued at the moment. Just less than 12 months ago, our share price was 8.8 cents. We were touching on sort of 90 plus million market cap, and today we're at 30 million market cap. So I think it certainly wouldn't be a very good time for us to go out and do a placement today. It wouldn't be seeing true value in Pureprofile, and it would be over-diluting existing shareholders. So great, we're cash flow positive. We don't have to do that, but equally we don't have to go out and do an acquisition. So I think that stops you doing any major acquisitions, which is fine. But it gives a good opportunity of doing smaller acquisitions that perhaps are script only, 12 months plus earn out. And why that's a good opportunity is our share price is low. And so somebody that we're looking perhaps to acquire is getting a share price today with a 12-month or 2-year earnout, depending on results, and they actually will see the share price go up. So actually they've got two ways of earning for their acquisition and their earnout. So it lends itself well to small scrip-only type aggregation acquisitions, and that's certainly what we're looking at the moment.
Well, I'm looking forward to catching up with both of you over the course of FY23. Thank you so much for your time today, Martin Filz and Melinda Sheppard from Pureprofile.
Thank you very much, Finola.